Hey guys, this is Joe Ham with the Realty Team, and in this video, I want to talk about in detail what is a good deal. Everyone talks about I want a good deal, but I think we should look into what exactly is that, and specifically what is that today? What is realistic? And so I think there's three big pieces to what is a good deal. The first one is the look back method, which you can't obviously do up front, but it's how you can kind of reflect on portfolio in terms of uh, looking back in 5, 10, 15 years, looking back on it. Did you make money? Was there cash flow? Was there ROI? And the example I'll use is 4 years ago, Austin, Texas versus Detroit, right? Anybody in their right mind would have said, well, Austin's a better investment, right? Everyone wants to go to Austin. It's COVID. That's put your money in Austin. Um, Contrarily, I dumped all of my money in Metro Detroit. Now, 4 years later, we do the look back method. Um, Austin has had multiple years of negative, upward around 10% negative appreciation and no cash flow. Those houses don't cash flow, and then negative appreciation. And then versus Detroit, 2023 was the number one appreciating market in the entire country at 8%, and hundreds of dollars per property in cash flow, especially now later, 4 years later, cash flow continues to grow. I look back on our portfolio, hundreds of dollars per door, 8 to 10% appreciation across the board, if not more, versus that. Detroit won. It was the better investment. 4 years ago, if you could dump $1 million into Austin or Detroit, Detroit would have grew your money substantially more, and you would have had the benefit of cash flow. Whereas if you still talked theoretically to people, they would still kind of look at me, well, I don't know, maybe Austin was the better because they're so wrapped up in theory and numbers and predictions and stuff like that. But just look at actual data. And if you look back a couple of years, Detroit won. There's no question about it. You can't deny it. So I think that's really important to keep in mind. It matters on what results you get. Anytime someone says an area isn't a good investment, it's like, well, what will happen in 10 or 15 years? As long as I don't go negative appreciation, maybe I can get the average 3% appreciation. This property's cash flowing or close to it. Um, if I own this property in 10 years, what will make it a bad deal? As long as it does those two things, it cash flows, it appreciates, and the loan gets paid off. In 30 years, you're sitting on a $500,000 house that's completely paid off and it's cash flowing tons of money. That's a good deal. Look at it from that perspective of where it'll be. Second is your risk and reward, right? So you can't expect high reward in an A market. So A market, probably negative cash flow. You're just buying for it's your A plus stock. You're looking for the easy experience and just parking your money. B's a little more, maybe we get around break even, but same thing, kind of easy market. Long term appreciation is really your only play. The C market, again, is not that it's not appreciation, it's just also cash flow and appreciation, but a little more work to it, right? You're in a C market, so now you're talking some cash flow, but again, you're still most likely going to get this appreciation. It's just going to be coming from a lower price point, which is good for most people. D market is okay. You're talking. It looks really good on paper. It's really hard to execute, and there's going to be times when it doesn't execute and it doesn't work out. If you're watching this video, I'm probably not going to recommend that you look at a D market because if you're studying at this point, it's going to be very difficult and also partially unlikely. F market, no one should really buy those. It's just they're so hard to execute that they almost borderline. Some of them are borderline impossible. Like the numbers aren't there to make them work. Even though it's a $10,000 house, it's just like yeah, but it's got a $150,000 rehab, so might just not be the best play. And then the third one is where the market is at today. So a property in 2022, the numbers on that might have been 12 to 14% cash on cash ROI, and X total ROI. Whereas today, 2022, we had rising prices, but they were much lower prices. We had very low interest rates. We had lower taxes. We had fast rising rents because there was a lot of that money going around. 2024, we have high prices. We have very high interest rates. Not very. We have high interest rates. Taxes are up. They've kind of caught up, and the rents have kind of stalled a little bit. They'll pick up, but for right now, they've stalled. So today, what is possible today, year one, cash on cash ROI just isn't the same as it was in 2022. So you can't compare to what 3 years ago was a good deal because the market's changed. So you got two pieces to this. You can pick your location, and I'm talking about comparing markets. So Detroit versus Austin, Detroit versus Miami, Florida, whatever you're looking at. The first thing you got to do is just pick the best of what's available. So there's cash flow markets out there. Pick one. I personally believe Metro Detroit has been very tried and true. It still has some of the best price to rent ratio in the country, and also now it's boasting some of the best appreciation in the country. So I like this. So I know that if I pick what's available in Detroit, I'm already beating pretty much what's available anywhere else because I've picked the best market. The second piece is pick the best of what's available in that market. So now we go into Detroit, Metro Detroit. Now we just look at what's available. We can't drum up a deal from 2022. It's just not available today. But we can look at all these houses. All right, 100 houses. I'm going to narrow that down to the top 10%, top 1%. I've got 10 houses to choose from on the entire market. I think these are the 10 best. Pick one. That's the best that's available today. And what today that looks like, I pulled one up here. I actually think this is this isn't a good deal. I think this is a great deal by today's standards. So we got 6044 Glennis Street, Taylor. This is on the market today, November 15th, 2024. 2 bed, 1 bath, 700 square feet. Again, I don't buy into the whole has to be a 3-2 basement and garage. Why? If in 10 years this property makes me more money than that, who's to say that this wasn't a better deal? Well, you might not get tenants. Well, but I will get tenants. I do get tenants. My rent's just a little lower, but my price to entry was lower. So my ROI is actually higher because I'm buying a slightly less desirable property. So therefore, again, 10, 15, 30 years, it's hard to deny that my money wasn't better spent here. Quick little rant there. I'm trying to go fast. I don't like to make these videos long. So we got this property. I threw it into a calculator, and 75 purchase price. You can look through these. I'm not going to talk through them all, but I got all these expenses. I got budgeting for vacancy, maintenance, capex. Got property management here, insurance, taxes, and this thing is 10% cash on cash. Year one, your $29,000 investment is pumping out 10% ROI and $240 a month cash flow. By 2024, November 15th standards, this is a great deal to go pick this thing up. It needs some love, a little light sweat equity in there, which is great. That's part of what makes the ROI higher. That is a good deal. So then let's look at the total ROI because you've got to look at total ROI. If you're only looking at year one, you're really missing the boat. So again, we've got all the numbers in here, and then here's our year one 10% cash on cash ROI. But don't forget, we got to look at all the other ways we're making money. So our sweat equity year one, we made $11,000 because it's a $75,000 house. We put 8 to 10 into it, and now it's worth 100. I verified 100 by looking at comps. It's in a really good area. So we've made $11,000 simply in sweat equity. Our cash flow is 10% year one. Our debt pay down 2.5%. Remember, the tenant, we're not counting his cash flow, but the tenant's putting money into our bank account, our mortgage. So that's ROI. You're just not seeing it at this moment. 2%. Tax savings, not going to break this one down, but through depreciation and write-offs, you're looking at, again, this money earned versus stock market money earned. You don't pay taxes on nearly as much money if you can write off most of this usually. So you've got ROI there because anywhere else you would have had to pay taxes. Then your appreciation, again, it's not just your $30,000 that's increasing at 3%. It's the $100,000 ARV that's appreciating at 3%. So that's why $100,000 goes up 3%, you made $3,000, but you made $3,000 on your 30 grand investment. So it's 10% ROI just on that appreciation. I mean, you're smoking the stock market simply by leveraging your money in real estate. Plus, you get this nice 10% cash flow on top. And then the sweat equity. Again, you invested $30,000 and you made this $12,000 in sweat equity. You go 68% ROI. Uncomparable to borderline any other investment in this world. But so many people will see this deal and be like, 10%, I want 12. Like, but this is the best of what's available right now. So you let this go by, there's a good chance, a couple months, what's a good deal then might be 7%, you know. So I think that's the bottom line is in today's market, I think that is a fantastic, great deal. I think 5 to 10% is a good deal. Personally, my last couple buys this year have been 3 or 4%. Why? Because I wanted that. I wanted to go up one notch on my last couple buys. I went into more of a B market. I should say B class property. You know, they're all brick houses, and nice that way. So I went up a level in property and dropped my expectations for my ROI, and I went sub 5%. They're cash flowing $100, and they're appreciating, and that's just what I wanted to add. In 30 years, they'll be paid off $300,000 houses, and then they'll be cash flowing $1,000 a month. So I think that's the bottom line is $50 to $150 a month cash flow, and you know anywhere in that mid to high single digit cash on cash year one, and then I think this is really high because this is a sweat equity. But I think if you're getting 20% on this total ROI, especially if you're not getting the sweat equity 40% boost, say you're buying turnkey, this would be 40% lower. So if you're in that 20% total ROI, I think that's a good deal. Hope you liked it. Hopefully that helped. If you have any questions, that's what this is for. This is really just a conversation starter. Let's talk about it. And if you need any help, www.firerealtyteam.com, and we'll get rolling.